Welcome back, everyone. It is Tuesday, November 24th, and this is where we cover everything that's going on in the markets and around the world, looking back at last week and seeing what's coming up this week. My name is Michael LeBlanc, Director and Senior Portfolio Manager at Canaccord Genuity Wealth Management, and thanks for joining us here. Every week we do this live at noon, and of course it's available for viewing on recorded. We'll send out the recorded version afterwards as well. So thanks everyone for joining us. It's been fun doing these things. We also do our Mike on Money show, which we put out try to get it out Friday. Sometimes it's Monday. Last week we covered the healthcare sector. If you're thinking of, a lot of people are talking about investing into healthcare. Of course, a lot of talks around the vaccines, the treatments, and just in general, the healthcare industry as a potential growth sector. So I did a deep dive into that last week. So if you want to see that or any of our other videos that we've done, please go check us out at mikeonmoney.com. You'll be able to link to any of our channels there, and also look for our material coming out on podcasts. We're right near launching that. We were going to launch it yesterday, just getting through the last couple of administrative issues to get that out, but that will be out starting this week, and you'll be able to find most of this material on podcasts if you prefer to listen to some of these things on the go. So with that, let's cover some things off. Of course, as always, this is for information, educational purposes only. Don't take anything we say here as advice. Everyone's situation is different. Do seek the advice of a professional advisor, or do your own due diligence before applying anything we talk about or strategies to your portfolios or to your financial plans. Always happy to chat, take a look at your situation, review your current situation. So you can always reach us again at mikeonmoney.com. Give us a call, email us, or you can even reach my calendar right on there. So as always, your microphones and videos are muted, so don't worry about that. If you're having a coffee, dogs barking in the background, no problem. But if you do want to ask a question, you can just click on that Q&A button. You can type in your question. We'll try to get to it before the end of the session. If not, I will definitely follow up with you after the session. Sometimes I go long on these things, and I try to keep it as limited as possible to be respectful of everyone's time. But by all means, or if you think of a question afterwards, if you're watching on the replay, again, just give us an email or give us a call. Happy to answer those questions. So let's dive into what's going on in the economy. We are looking for the new PMI numbers for November, the manufacturing numbers out of the US. In fact, we've seen some early ones this morning. I'll touch on that in a moment. And also the service numbers for the US. I haven't seen those ones yet, but they should be in line with the manufacturing numbers. And pretty much the trend, as we've been talking for the last few months, the trend has been improvement in all these numbers, and we're going to keep an eye on that. And really what we're looking for is how much their improvement is. They're slowing to that improvement. Are we maxing out and kind of slowing down a little bit, or is it continuing to rise every month? We have seen a good rise in the stock futures on Wall Street in the US and the S&P 500. Also the NASDAQ, all in positive territory starting this week. Obviously, with a lot of talk of more and more vaccines, another vaccine coming out of the UK with the Oxford University had been working on that one. The interesting one about that one is it can be stored above 0 degrees Celsius. So as far as shipping and storage, obviously a lot easier to get out to the masses, get out to rural areas, and obviously countries that can't afford or don't have the facilities to store that Pfizer vaccine, which had to be at minus 70 degrees Celsius. So very positive news there, weighing onto the markets. More and more hope coming that we're going to have a vaccine either late this year or certainly into the new year to start building anyway some sort of normalcy with this whole COVID thing and getting back to not having to have closures or shutdowns. Europe is still having a lot of challenges. They've taken a much more stringent approach than, say, the U.S. has, or even Canada, and to some extent, in stemming the second wave, where they've gone back to full restriction mode, and that's taken a bit bigger hit on the economy. The one thing I'll say about that is, of course, that's happening there. We are seeing the economy slow down there again, much like we saw it here during the first wave. But that's actually something for us to keep an eye on. If we do have to go into that full shutdown again, then we might see that here in North America, right? If we have to go there. Of course, Canada's been trying to, do partial, certain here in BC, where we're kind of shut down in our homes, away from outside our immediate families for a little while here, but restaurants and businesses are still open, or some business. Obviously, the gyms and that have been affected. But in other areas of Ontario and Quebec, that they've gone and closed the restaurants and stores as well. So we'll have to see where Canada ends up, but hopefully we can avoid it. I'm not sure if we can, but hopefully we can avoid it and miss that second bigger hit to the economy. Other things going around the world, as I mentioned, Oxford University coming out with their vaccine. They came out with their announcement saying, it's been decades of work to get the expertise to develop it that quickly. The other thing about their vaccine is the percentage of success isn't as high as the other two, but the distribution ability is one that makes this one really interesting. Last week, we talked about the 737 MAX 8 planes, Boeing going back up for review as to whether they get their approvals to fly again, and they did. So now Boeing is focusing on getting all those planes delivered to the airlines. Of course, now we've got to see how many of the airlines are going to take delivery or start putting those planes back into service, just given to the current level of travel that's happened, especially on the international stage. There is a lot more travel happening a little bit inside the United States, but not so much crossing borders, obviously, with all the close downs that are happening. Pipe dreams leave the U.S. energy firms caught in the climate trap. So this, just talking about, what's been going on in the energy sector since the beginning of this and continued through the pandemic is oil and gas, being hit pretty hard. There's more pipelines projects being put on hold due to demand fall off. And one area that's come up as a problem in Michigan, or northern Michigan, which is more rural as far as utilities and services go, getting the propane piped up to them, or getting it to people. And we saw back in 2014 where the prices almost doubled on those commodities because of the shortage to get to families who rely on it for feeding their homes. So there's a big concern that might happen again. Probably not on the natural gas front, but definitely on the propane, which is more shipped and stored. Natural gas is mostly all pipeline. U.S. manufacturing service activities expanded rapidly. So we talked about, mentioned we're looking for those numbers. They did come out early this morning. So the manufacturing numbers have risen again, a little bit slower than some previous months and anticipated, but still showing an improvement. So that's good. Something to keep an eye on. Obviously, keeping a close watch on the second wave. And then we're also seeing an end of the crisis programs. The Fed is facing a tricky post-pandemic transition. So, as those vaccines come out and we start to say we're going to return to normal, what is the Fed's plan? Now, we've talked about several of the committees that have been established and several of the strategies that they hope to achieve. The biggest one in that strategy is keeping interest rates low, keeping liquidity high, fighting off inflation with other tools other than interest rate hikes. Because as we come out of this, one of the things to keep the economy growing is to keep money cheap, right? Keep that liquidity moving. If we start to see rate hikes in interest rates, that can really slow the economy. And if inflation starts to get out of control, Of course, that's not going to work out well for anything from housing to job creation to economic expansion. So we're really going to have to take a look at the plan as we come out of this, and of course we're going to see a new U.S. government come in to put that plan into place. So all these things, I know Biden has been naming his team, and as that develops, we're going to really take a look at the philosophies and strategies that those individuals have used in the past to kind of see what the U.S.'s strategy is going to be to rebuild that economy or keep that economy on track and moving. Williams is restructuring their midstream contracts as they take over the assets of Chesapeake, which went bankrupt earlier this year. Again, oil, energy sector bankruptcy. This one happened early on. Williams has taken ownership of all their assets, and now they're out there renegotiating contracts, contracting with the shale, or working with the shale producers to deliver those services on a cost-effective manner. And this is a theme we've talked a lot about through all this, is this mergers and acquisitions, bigger companies taking smaller companies that may not have gone into this in the best health. And that's where, we have to not just watch how they restructure, but the big thing there is how many layoffs, how many more job cuts, because as we've talked about through all this, the economy being able to maintain growth is going to rely on that inflation, those interest rate numbers, and also the unemployment numbers. So keeping those unemployment numbers down. And anytime you have a merger or an acquisition, the concern is always how many jobs are lost, because there's always efficiencies to be had in those situations. Sixth Street backed AvePoint to go public with a $2 billion merger. So this is the cloud data management. So, we've talked about technology. We've done a deep dive in technology. Not this week, last week we did an interview on the cybersecurity sector, which is just booming. Like, the rate of growth is incredible. Another sector that we haven't dove into too much yet is that cloud data management sector. Everything is going cloud these days. If you're not going cloud at home, I guarantee you every company that you deal with is moving to cloud. The idea of having on-site servers or on-site data management is something of the past. Everyone's moving to the cloud, which is where that cybersecurity lends into to protect that information against attack, but also against loss. So those companies we're seeing massive growth, and it's not just the Amazons, it's not just the Microsofts of the world. There's a lot of up and coming companies in that area. And Sixth Street is out there taking AvePoint public in a $2 billion deal to bring a new into the market. So these are not smaller companies, and they're growing massively, and which is why they're out there trying to raise capital. So that's an area of the market we should keep an eye on for the portfolios, certainly an eye on for growth. As always, we take a look at the numbers, and scarily enough, we're almost at 60 million total cases worldwide. In fact, based on when we take these numbers, we're probably through that already. 1.4 million deaths. The US through 260, almost 265 deaths, almost 13 million exposed. Canada, 11,580 deaths, almost at the 340,000 cases. And again, as I always say, there's not a complete list. This is just kind of to fit on our chart here, but obviously the numbers are growing massively every day. Hopefully the vaccine will come. Obviously, again, we've talked about the vaccine many times. It's not going to be an overnight. It is going to take time, obviously, to get out everybody, to get everyone inoculated, and also to see the effects. Some of these vaccines are 2 vaccines, so 30 days apart. So, and then another 30 days before it actually starts to create the antibodies in you. So even if you get the vaccine January 1, it could be end of March before you're actually partially immune. Again, the vaccines aren't 100%, but partially immune, or at least showing resistance to it. And we're going to, and not everyone's going to get it January 1st, right? It's going to take time to get out there. So, what we hope to see, as we've always said, is decline in numbers and less pressure on the hospital system, on the medical system around the world. So that's what we're targeting when we look at these numbers, and hopefully we'll start to see those sooner than later. As of right now, the numbers are continuing to grow. Let's talk about the US, specifically what's happening in the market. As I mentioned, things have been going well. The stocks have been rising this week and end of last week on the vaccine news. We've seen a little bit of weakness in the US dollar coming off its peak. Very normal. Again, the US dollar is a flight to safety. So if everyone's terrified, money flows into the US dollar. If people are starting to feel a little bit better, money flows out. We saw gold prices fall a little bit due to the strong business activity, but again, not a big concern. We do have that inflationary play playing out down the road. So overall, pretty good. Oil prices surged 1%. It's still within that range that we've seen it kind of since the supply has been cut earlier this year in May. Again, no big pressures pushing that up. Medtronic is set to post their second quarter results. If you're not aware, Medtronic is one of the major companies out there creating the ventilators that are being used for the treatment of COVID. This is going to be an interesting one to watch. Are we going to see demand fall off here as the vaccine comes out? I mean, obviously, hopefully, the result here is that we won't need as many, or we won't need more and more and more. But we have to really watch a trend on those orders and deliveries and see kind of how they might play out, or how their stock might play out here as things start to drop a little bit. Now, keep in mind, ventilators are used for other things than COVID, and there is a built-up demand of elective surgeries that have to get caught up on. So the demand might remain there for ventilators for a period of time afterwards. So again, we'll take a look at their second quarter results and keep an eye on how things are going. Best Buy is expected to report their third quarters. Of course, we're expecting pretty good numbers here, boosted by people who need laptops, computers, webcams, for the work at home or study at home environments. We're also looking to see how their Apple sales have been going, to get an idea on the latest iPhone sales and the iPhone Mac Air books and all the new technology and watches that they've been rolling out. So it'll give us an idea of kind of how Apple is doing as far as their next quarterly numbers coming out. Dollar Tree, is reported, as we talked about Walmart a couple of weeks ago. It did really well. We're certainly expecting Dollar Tree also to be doing well. We always see these discount stores perform quite well. Anytime there's pressure on the economy, especially with higher unemployment, people looking for lower cost access to products. And staying away from the luxury brands, especially going into the holiday selling season here. Also in the US, AstraZeneca, they're the ones that are working with Oxford University. That's their vaccine. Can be 90%. As I said, their numbers were a bit lower. I think the best report I saw said that we're between 70 and 90% effective. So not as high as the other one, but again, if you can get faster to market, more access to more people quicker, it may still be the better vaccine. Also, when we talked about the vaccines, the healthcare video that we did last week, keep in mind, not any one company has the capacity to distribute these vaccines. We're talking, if it's 2 vaccines per people, 7 billion people in the world, that's 14 billion vaccines in a very short period of time. No one company is going to be able to produce that. So it is going to be a shared success. Whoever's vaccine or multiple vaccines will probably be put to the market all at once, or all within the same time period, all being produced by multiple different manufacturers, even if it's not their own product, just to get it out there in time. So we want to keep an eye on that whole sector, which is why we did that video. So you might want to go take a look at that one. The latest U.S. jab at China. So they've come out with a draft list of 89 firms with military ties that the Trump administration is declaring they're going to restrict from buying a range of U.S. goods and technology and have access to different things. I believe there was 31 of those companies were actually blacklisted from any U.S. investment Obviously not boding well for the US-China relationships, as that's been going on back and forth, especially in the technology arena. Of course, there was the big back and forth over TikTok, which seems to has fizzled out a little bit. Obviously, with a change of administration happening in the US, we'll have to see how all this plays out, but still putting some strain on the China-US relationship. Google's under review for possible British competition inquiry. So this is just on the heels of the Amazon inquiry that the EU and the UK are looking about data gathering and how they're using that information and whether they're making that transparent or available to others, or whether they're using it solely for their benefit. So it all goes down to those antitrust rules. Of course, we're seeing that in the US as well, where all these major tech firms are down there testifying about how they use this information and how they apply this information. This is going to be an ongoing thing. It will end somewhere. I don't think it's anything going to be massively impactful for these companies. They might have to adjust. They might have to release some of that information down the road. They even might have to pay some penalties down the road, which they have in the past many times. And I doubt we'll see that change too much. We've talked about gold for quite some time. JP Morgan has dominated that market with $1 billion record of precious metals revenues. So that's how much transaction is going on in the precious metal market as institutional and trading is really focusing on using gold as that hedge, as I mentioned, on the inflationary front. GM took an interesting early move, I guess, to reverse Trump's efforts to ban California emission rules. So I'm not sure if you followed this story back in the before times, before all this. California, as a state, had set some emission rules for the state of California, and many car manufacturers started building or speccing their vehicles to California's emission rules, as basically California was just following the federal rules, but they were just doing it faster than the federal government required states to get there. So GM basically is now saying, well, Trump came in and said, or Trump administration came in and said, no, we're not letting California set their own rules. They have to follow ours, and we're actually going to ease our rules. Well, GM's kind of come in and got ahead of that, and talking about, again, refocusing on the original California rules, stepping up how quickly their emission standards are going to meet, moving closer and closer to cleaner vehicles at an accelerated pace, which is kind of, it's funny that they're jumping ahead of the change administration. Of course, the Democrats have already said that they're in favor of clean technology. And again, I've mentioned in previous ones, and we're going to do a deep dive on this one. I'm hoping to arrange something this week, but we're going to talk about the electric car manufacturers. We've done a deep dive in Tesla's stock, but not necessarily the industry, because more and more we're seeing that this is the way that we're going. UK has already announced by 2030 they're banning all fossil fuel cars sales. So no gasoline cars, no diesel cars after 2030. Quebec here in Canada has said 2035, no more. And I'll expect more and more countries and countries and provinces and states start to follow this trend as that technology is catching up. It's becoming way more affordable, way more accessible. Of course, Tesla was the kind of the groundbreaker, the disruptor to get there. But now there's many companies out there producing. They're not all available here in North America, or certainly here in Canada yet. But in Europe, way more so, and a very large one called NIO out of China, and the next wave of this technology is becoming very affordable, meaning on par or even sometimes cheaper than fuel-based cars, in two fronts, not just on fuel consumption, but electric motors require much less maintenance than a fossil fuel or gasoline or diesel vehicle, just because of the less complications of the and less heat and all these other things, the way the vehicles operate. So as far as ownership goes, the prices are coming way down. So GM getting a bit ahead of that. Funny that they would come announce it prior to the government's transition as far as the California rules go. And they're probably going to be usurped by other companies who are going to, again, move away from just the California emission rules, but right to the electric and hydrogen. Hydrogen is making a comeback as well, with a couple of companies like Toyota coming out with a hydrogen-based car. Coming up in Canada, we're looking for the oil production out of Alberta. It's expected to run really low, about a $24 billion deficit since we've seen the collapse of the crude market. We don't see much early signs of improvement there. We have seen a bounce in some of the stocks. We have seen a bounce on as mentioned, oil rallied a little bit to about $43 a barrel on the vaccine announcements, on that expectations of things opening up again. But really, we're still, as we've talked about, I won't beat that dead horse. It's going to be a while before we really see a pickup in demand, a pickup in usage on that front as well. We're also looking to hear from Kirsten Hillman, Canada's ambassador to the U.S., just to talk about her relationship with Biden, or how she feels that relationship's going to go. Obviously, that's going to be a focus for Canada, as we weren't doing well with the Trump administration. Hopefully, we can do better with them. Especially when it comes to environmental issues, which was a big sore point between the Canadian policies and, of course, the U.S. policies under the current administration down there. We're also going to hear from François-Philippe Champagne, is due to testify in Parliament on the Foreign Affairs Committee prior to next year. So that's just to talk about our plan for our foreign affair policies. Obviously, we still have an ongoing issue with China we're trying to do. But some good news happening with the UK, with Canada having a preliminary, anyway, or interim trade deal with the UK post-Brexit. Bank of Canada says it sees no sign of stress across the financial system. So, post 2008, Bank of Canada came out with these stress tests, or these stress indicators, to see how healthy the financial companies, or the banks, essentially, but financial industry in Canada is doing, to kind of see early signs if anything's under risk. They don't see any concerns. Loan loss provisions have been good. Defaults have been low. So overall, the banking system is looking really good in Canada. Canada is looking to approve a COVID-19 vaccine in the early new year. I know the US is pushing for their CDC to get emergency use prior, or hopefully in December. And Canada's going through a similar process to get an early approval here in Canada, but probably not until January. But obviously, they do actually have a more robust rollout plan. In fact, there was a ranking by the WHO, or the World Health Organization, saying that Canada was, I think we were number 1 or number 2 globally as far as readiness for the rollout. So, very positive for Canada once we do get that vaccine in hand to be able to get that out. Canada's October wholesale numbers, we saw a rise, which is great. Again, it's that we're keeping an eye on how much it's ramping up. Are we seeing regular increases? It's pretty steady on the increase, not really seeing a rise, but not a pullback yet either. So positive on that front. On the dollar, I mentioned the US dollar pulled back against its basket of international currencies. Pulled back a little bit, just 0.2%. Again, we see that on a steady decline as things improve. The sterling rose a bit, and again, this is on news of the UK and the EU potentially coming to a trade agreement, and of course, Canada and the UK having an interim one in place for post-Brexit trade deals. So, some positive news around the sterling there, and I do expect sterling to do well once we get past all this Brexit stuff in the longer run. Bonds saw a little bit of tick up on the longer term bond, a little bit of movement. Again, we're not seeing yields move very much. The goal is to keep interest rates as low as possible. Ideally, they forecasted 2 to 3 years that they want to keep interest rates low. Will they be able to? That's the plan we're waiting to see, is how they're going to do that, because it'll be a tough task against inflation with all the printing of money and stimulus packages that we've seen out there. On the commodity front, as I mentioned, oil moved up just above 43. So a good little bump up, on the hopes of the vaccine. But I would still be very cautious of playing in that arena, just because it still might be early. We probably will see a couple more setbacks. And again, we haven't avoided a complete second shutdown in North America. Obviously, in Europe, we are seeing a complete second shutdown. Could we see that here? It's still in the cards. We're not out of that arena yet, even with the vaccine coming. So let's talk about recession proof. I've had a lot of questions about, are we in a bubble? Is this going to pull back? Have we rallied too fast? Could we see another major pullback into the markets? And all those things are maybe. We have to be very cautious here. There is definitely, and if you follow me regularly, my thoughts on this, is there are definitely areas of the market that are way overvalued, have moved way too fast. If you've done well, recommend taking some profits. We call it trimming. So don't get out of a position, just reduce how much you might have in that position. Take some of that profit out of there, move it to other areas or move it to safety. Especially in those names that have gotten ahead of themselves. We've seen a lot of that in tech, but not solely tech. We've seen it in other areas. As I mentioned, I think oil's rallied back too quickly. So if you did happen to hold on to some oil stocks through all this and it's rallied, there's nothing wrong with taking some out and wait to buy it back on a pullback again, just to protect those upsells. You may have heard in the past, sell on strength, buy on weakness. So when you see good news, sell some out, and then when you hear bad news, buy back in. Because if the company you're buying is solid and the earnings are solid, then it will come back up again. So taking advantage of that. So that's not the rocket science I want to talk about today, but how to deal with a potential recession. So one thing I think, when people look at after what we've seen a great summer here, we've seen some very positive market numbers, some record high numbers. Obviously, all during a very turbulent time. There's been a lot of things that have lent to that. Obviously, government stimulus packages have, the hopes of going back to normal society, or post-pandemic normal society. How do you deal with that quick V-shaped recovery from the March lows that we went into? Well, sometimes we see people will make a few errors. One is to go to cash. Now, going to cash for a portion of your portfolio is not a bad thing. I use that strategy in our portfolios mostly when I can't find anything affordable to buy. So it's not that I'm going to cash to avoid a downturn. It's I've taken profits out of something and I just can't find anything immediately to buy because there is an overvaluation in the market. So there's nothing wrong with that. You shouldn't panic buy just for the sake of being in the market. But going to cash strictly for the sense to go to cash is an emotional reaction. I'm going to pull back, try to time, the top of the market, and then get back in when it's low. Very, very difficult to do for a lot of reasons. One, how low is low? Because if things were to pull back, are we prepared to jump in, pull the trigger, if you will, on the purchase? And what happens if everything goes lower again the next day? Do you get out again and then try to get it, see how far it goes? So buying in back at the bottom is almost impossible. So getting completely out is difficult. And then also, as we've seen sometimes in these markets, we've seen the pullback, but then a day or two later, we're back at new highs again. So could you take the money out of the market and then miss, that jump and have to buy it back in at a higher price? So never do I generally recommend, avoiding a potential downturn by going to cash. Now, excuse me, that doesn't mean, I'm just gonna have a little bit of water here for my branded cup, so it's all marketed. The idea of protecting the portfolio doesn't mean necessarily going to cash. What it means, going to other areas or other parts of the market that will be less affected, or other companies that would withstand a pullback in the economy better and would recover faster. So there's a few myths and things to keep in mind. I've touched on this early kind of, I want to say March, April time period is, a lot of people will look at value indexes or value stocks. So value, people will often try to buy things that are, have fallen and are still cheaper than everything else, right? So if a company has lost value in the market, it's still cheaper than its peers, and they'll say, okay, that one's cheaper, so it has less to fall. I want to go buy that. We call that a value trap sometimes because there might be a very good reason it's cheaper and it's not going to come back as fast. Certainly during this pandemic, I had a lot of conversations with people about, that pullback in March. And, of course, if you follow me, Visa is my favorite go-to story. So I'll talk about it again. Visa fell in March when everything went off. Of course, all stocks kind of pulled back. But it only fell about half of what the market fell because it is a good company. It's good cash flow. And I was telling people, if you've got cash, let's buy more Visa. It's a good company. Let's buy into it. And a lot of people saying, oh, yeah, but Carnival Cruises and American Airlines, they've all fallen a lot more. They will bounce back a lot more. But of course, what we've seen, that being a value trap, there's a lot of reasons why they fell more and why they didn't bounce back as fast, because there was a lot more problems in that sector or within those companies that's going to hold them back. And in fact, we saw Visa's not just bounce back to where it was way faster, but to all-time highs. So the performance there has been amazing versus, those companies I mentioned, American Airlines and Carnival Cruises. Yes, they have recovered, not to where the previous high was, and certainly not near the percentage that those better companies have recovered to and got to those new highs, because they were fundamentally a better company. So jumping after value is the first mistake not to make. What I do recommend, though, is really looking for those dividends. And I got to move my little face here out of your way from the slides, but look for those dividend paying companies. Now, not just because they pay dividends, but really look at cash flow. Cash flow is king. Cash flow is great. The fundamental of all the purchasing that I do for equities for my clients is how strong is that cash flow? Is that cash flow improving over time? Is there any pressure on that cash flow if we were go into a recession or into a downturn? We talked about early on through this, we got into the grocery stores. They've done great because, yes, their stock prices came down, but their cash flows did not, because people went out and bought everything, right? The toilet paper run, which I hear is happening again now. Costco is running out. Don't go panic and buy any. But, the grocery stores did well. The supply chains did well. So those are type of defensive stocks you can go. So you don't have to get out of the market. You might want to move away from the really high fly-in growth stories, because they will be the most profit taken on, the most selling off if we do see a recession. But that doesn't mean you have to give up growth. It doesn't mean you have to give up good investing. You can just go to companies that would fare better during a downturn. So really look at those dividends, look at those cash flows, not just dividends, because they might be still paying dividends, but not have the cash flow to support them. We're seeing that in some of the REITs right now, the real estates. It just came out that Hudson Bay hasn't been paying their rent, and their landlord's taking them to court and all this. So, if you take a look at a real estate REIT that has a lot of commercial clients or tenants who haven't been paying their rent, of course, paying their dividend is going to be very hard to maintain if cash flow has been interrupted. So again, it's that cash flow side of things. If the dividend's strong, and they'll pay well. And even if we see a longer downturn, so if we do see 6 months, 8 months of the stock price being down a bit, if you're still collecting that dividend, then you're going to do really well. If you followed us earlier this year, my big recommendation was to buy TD Bank or ZWB, which was the ETF that owns the big five banks. TD was at $59, at $71 now. 59, the dividend was quite strong. And in fact, ZWB, I think the dividend was paying about 6% at that point. Obviously lower, paying a higher price now. But nice strong dividends, good cash flow. Those companies will come back and do well. Don't ignore bonds or fixed income in your portfolio. I couldn't find a good bond image, so I hope you like my 007 image here. You can't, the bond market has not been healthy. Interest rates are really, really low, but they are a hedge. They are negatively correlated. And that's something else to really look for in a portfolio is negative correlation, which means when the stocks go down, the bonds might go up, or at least hold their own, or even if they're only paying 1 or 2%, it's better than going negative for a time period, right? While you wait out to find out what's affecting the economy, how long this is going to be a downturn, and can how quickly can it recover. You can slowly move back into maybe some more equities, but don't ignore that side of the portfolio. Yes, there's some strategies that you want to play with. You want to be careful of high yield. You want to be careful of short term. You don't want to be too long. I know the fixed income bond markets are much more complicated than almost equity markets and stock markets, but don't ignore it in the portfolio. A lot of people will just give up on that, especially in these days when people want yield out of their portfolio and are chasing the yield from equities, which of course carries a little bit more risk, but also carries positively correlated risk. Remember, if you're all equities, even if you're sector diversified, there is that positive correlations. They do act, maybe not to the same degree, but they do act similar. When we're seeing an economic downturn, most stocks will go down all at once. Again, different sectors to different amounts, but they do react the same, whereas bonds might react differently. So that's that different opposite correlation for your portfolio. So don't ignore those. And also with that, keep long-term in perspective. Don't be worried about short-term. Most people say I'm retired or I'm just about to retire. Yes, but you're going to be relying on these portfolios for 20 or 30 years in retirement. So don't worry about 6 months of movement. Again, if you're properly diversified, you've gone to some of those protective industries. Again, you don't have to give up the growth we're seeing in the market. But at the same time, you don't have to chase every single high-tech company out there that is growing by 30%. If you could take advantage of just a nice little double-digit return on some of those cash flow companies, those less than sexy companies, those industrial companies, those grocery stores, the areas of the market that have solid and growing cash flows. You can still have some really nice, healthy returns, be protected against a longer term downturn, but also have that cash flow while things are repairing itself out in the economy. So I'm not telling you all this because I think we're going into another double dip recession. I just think that it's something you should be cautious of because we're not out of the woods yet. Take a look at how your portfolio is positioned, being well diversified. Really look at those correlations. I mean, that's a big part we put in the portfolio analysis and how we build the portfolio is that negative correlation we talked about, again, when we did the deep dive on cybersecurity. Cybersecurity is very negative correlated to the general market because it's something that has to be spent money on regardless of how well the economy is doing. Healthcare is another one. We just did that deep dive. We talked about how it's negatively correlated during recessions. How healthcare spending actually tends to increase. Again, very positive there, as far as a protective sector. And there's multiple others that you can take a look at that don't behave the same as the broader market during recessions. And that's what you want to diversify in there. So don't get caught up in the wave, be some protective, but also don't panic. Don't go to cash. Keep that long-term perspective in mind. You will do well over time if you've got all those components in your portfolio. You will fare very well, and you'll come out of it on top as far as performance goes. So with that, I'm going to end things, but thank you everyone for joining us. As always, visit us at mikeonmoney.com if you want to see any of those other videos I mentioned, sign up for any of our channels, ask us any questions. We will be back here again live next Tuesday at noon to give you an update on everything we see. And just to mention, while the Trump administration has not conceded, they have approved the transition team. So that's good for the U.S., obviously getting things ready for the January transition of the administration, especially around the the virus and vaccine rollouts is really important that's taken place. So that did come through yesterday. And if you're a Jeopardy fan, Ken Jennings is going to be the interim host anyway to start off to replace Alec Trebek, who passed just recently. So if you were looking for that news, I like Ken Jennings. I thought he did. He was a great. He was the winningest champion of all time on Jeopardy. So he's an interesting personality. So some funny trivia there for you, and I hope you all enjoy our rainy November that we're having, and I'll talk to you next week. Thanks, everyone.